So, is the buy-to-let market about to crash and burn? Well, we're about to find out in our latest webinar. There's a great Q&A section at the end of this video, and don't forget, hit that like button, hit the subscribe button for real-time buy-to-let information. Let's get straight to it. Hi everyone, welcome to this month's webinar. Now, this is a big one. We've got a lot of people who have inquired about this over the last few weeks and going back into the end of last year when we started to see some interest rate rises. People were simply asking the question, is it about to crash and burn? What are we going to do about our buy-to-lets? What are we going to do about our portfolios? So look, it's a great webinar that we can delve into a little bit more detail. And let's be honest, it's human nature. We think negatively. We always think the worst. So the reality is the majority of us do actually think, well, actually, when's it going to crash, or when's the crash going to be? So look, let's sort of delve in. So first things first is we have to look at a number of things when we're looking at the buy-to-let market. The first is obviously current affairs. This is always on the tip of people's tongues. They read the papers, and throughout the last decade, we've seen elections, we've seen Brexit, we've seen obviously the war with Russia and Ukraine, COVID as well. Everything like this has had a negative impact in the news, but actually it hasn't really dented the property market so far. So we have to take current affairs into consideration, but we don't want to place too much on them, because if they don't affect the fundamentals, then they won't affect the property market. So let's look at current affairs, and let's look at what's happening at the moment. But just slightly to tweak before we talk about the current affairs is, what are the fundamentals? Now, for those of you that join us on a number of webinars will know what the fundamentals are. So we talk about things like taxation, the three main fundamentals. So we've got taxation. Now, taxation obviously is something that is things like stamp duty. That is obviously taxation. And of course, the most important thing that we've seen is if they give taxation holidays, like stamp duty holidays, property prices go up. If they start to increase tax, like we've seen overseas tax, then many overseas people will try and get in before that tax kicks in, and then they will sort of peter off after that. So that's taxation. Legislation. So we look at things, for example, where they might change certain restrictions. They might turn around and say, well, you're only allowed one buy-to-let property or two. They won't, but that's an example of legislation. And then the last thing is liquidity and interest rates. So for example, if interest rates are increasing dramatically, or banks are not simply supplying the liquidity like we saw in 2008, then that's going to affect the market as well. But importantly, what we have to look at is we have to look at those fundamentals, and we have to look at how the current affairs affect those fundamentals. So look, as we're looking now in terms of current affairs, we're obviously seeing the big thing is Ukraine crisis. We're seeing daily front page news. Whatever we look at, it's all about the Ukraine crisis. Now, one thing that we have to look at is, how is it going to affect us indirectly? Because directly it doesn't. It's affecting the poor people in the Ukraine, and we're seeing these awful pictures come out. But the reality is what people think about is, how is it going to affect them? Now, what we have to look at is what we get from Ukraine and what we get from Russia. So when we import goods, what are we actually getting? So I've got a little list here from Ukraine. What we get: iron, steel, cereals, animal fats, and oil seeds. So the reality is, if those things are in short supply, prices of those particular goods are going to go up. So that means our cost of living is going to increase. Now, it's quite important that we've got iron and steel on there, because if we go over to what we import from Russia, and we've got things like metals, minerals, oils, wood, chemicals, fertilizer. Well, if we take two of those things, if we're importing a great deal of wood from Russia, then the cost of wood's going to increase. If we import a great deal of fertilizer and we have to go and pay for it elsewhere, and it's more expensive elsewhere, well, that's going to put the price of fertilizer up, and that will have a knock-on effect to our foods. So the reality is we know that this crisis in Ukraine is going to cause us an increased cost of living. Now, we're going to come back to this at the end, but the main thing that I want you to think about right the way through this webinar is, what does the cost of living mean for people that are now renting? What does the cost of living mean for people that are first-time buyers? And potentially, that is our target market. So if you're a buy-to-let investor, your target market is actually the first-time buyers just before they go and get that particular property. It's the younger demographic. They're the people that we want in city centres where property prices go up the quickest, in city centres where you are predominantly apartments, 1 and 2 beds, they rent unbelievably well. Our demographic is the young professional, just before they go and get on the ladder themselves. So what do you think they're going to do? That's what I want you to have in your mind throughout this. So if we talk about the Ukraine crisis, we obviously know that it's going to cause an increased cost of living. The people that rent are going to have to pay more. We know that there's going to be an energy cost of living as well, because we import a lot of oil, gas from Russia. Therefore, that's going to have issues as well. So these people are going to have less money in their pockets. So again, having in mind, what is that person who's renting now in that younger demographic? What are they going to be doing? If they've got less money in their pockets, what are they going to be doing? Are they going to think, do you know what, I'm going to go and buy now? Or are they going to think, I'll hold off? We then start to look at other current affairs. For example, we see that the cost to build properties. So we look at, the reality is if a property costs X amount to build, let's say you've got a property that would cost you typically 100,000 to build, and the developer will go and charge them 120,000 to sell it, for example. The reality is they'll make 20%, which is what they normally look at. If the cost to build that property is now 140,000, well, they're not going to simply sell it for 120. It just doesn't make sense. So two things will happen. They'll either put that property price up to 160, 170 and try and make their 20%, or they won't build it. So if they don't build it, it creates a shortage of supply, which is what we're seeing at the moment. We're seeing a huge shortage of supply. And we know that basic economics is supply and demand. If you have a lower supply, the reality is, and demand is still pretty stable, the reality is prices go up. Or new builds, they simply put the prices up and everything in the whole area goes up around it. So the reality is the property prices are still increasing because of the fact that it's costing more to buy properties, and we are seeing a huge shortage of supply. Now, why is it costing more? Well, since COVID, we've had increased shipping costs. Prices of timber have gone up 60%. Knock-on effect of that is we've now had the Ukraine crisis and Russia, and of course, everything. It's just the perfect storm of increasing the amount of prices. So property developers simply need to make their 15, 20%. And if they don't, they either won't build, or which causes a shortage of supply, or they'll put the prices up. It's as simple as that. It's pretty basic. And that's what we're seeing all over the UK at the moment. The last 3 months, everyone thought that the property market was calmed down, and we're still increasing prices at one of the fastest rates that we've seen in history of property prices, but especially over the last decade. We then move on to inflation. So what's happening with inflation? Now, the Bank of England, to be fair to them, are caught between a rock and a hard place. So I've always commented that the Bank of England make these silly statements where they say the property market's going to fall 30%. And when it doesn't, which they did actually say, they said when it was the height of COVID, the property market's going to fall 30%. They couldn't have been more wrong. It just rocketed up, and they said, well, it was down to them that why it didn't. So for me, that this conglomerate of people make these ridiculous statements, and effectively the majority of them don't come true. And how they get away with it time and time again, I don't know. But the reality is, in this particular situation, they are caught between a rock and a hard place, because what do? Do they put interest rates up to curb inflation? And to do that, they can't just put them up 0.25 or 0.5%. They've got to really jack them up 4 or 5%. So do they put them up to that level where actually that causes a recession? Because if they did, people wouldn't be able to borrow, and the people that have got mortgages or loans or high interest loans out there would absolutely struggle, and we would have a huge economic downturn. Or do they keep them low and risk the economy overheating? Well, it's probably what's the lesser of two evils. The reality is you're probably best keeping inflation running slightly hot, and actually the economy overheats very slightly. Whereas if you chose the other route, it would cause a huge amount of downturn, a huge recession. And of course, then I do agree, if we started to see 4 or 5% interest rates, we would see property prices come down. They would have to, because people couldn't afford the mortgages. So at the moment, I see that the Bank of England are putting up interest rates, but we're still where we were. We're still at huge lows, historic lows, where we were just before COVID. Because COVID came along, they did dip them, they did lower them, and they did move them down to an all-time low. But we are now back to where we were just before COVID. So actually, we're not much different to where we were at the start of 2020. So everyone's talking about, and especially in the newspapers and the news, about inflation and interest rates increasing. But the reality is, guys, is that we're back to where we were in 2020. We're not talking about what we were in 2007, 2008 times, where the interest rate was at 4 or 5%. We are still, under that 1% mark, and maybe by the end of the year we'll hit 1%. But you're still getting unbelievably cheap mortgages. If you're getting 3 to 4% interest on your mortgage, but you're making 5 to 6% on your property, you're still making 2% on your borrowed money and 6% on your cash. So the reality is that and that's just your income. If the property price is growing 5, 6% as well, you're making over 10% on your cash, and you're making, give or take, 6% on your borrowed money, which is still far better than what you would be doing in your bank. So current affairs aside, now I know we've skimmed through those, and there's going to be a question and answer session at the end. So if you guys want to sort of start thinking about what questions you want to ask, we can run through them. But current affairs aside, how do they affect the fundamentals? So is the Ukraine crisis going to affect the fundamentals in terms of legislation? No. Taxation? No. Is it going to affect banks' liquidity and interest rates? Yes, it will, that they will start to increase them, but I don't see that they're going to start to increase them anywhere near where it's going to impact the property market in a negative way. It certainly hasn't done anything thus so far. Again, things like the cost of building properties are increasing. So is that going to affect the property market? 100% it will, because as I said, if the cost increases, the developer either says we're not going to build because we can't make money, or we build and we're going to put the prices up to where our profit margin works. Therefore, either short supply or an increased amount of money. And then we come down to the last one, as I said, inflation. I just cannot see the Bank of England putting the rates up due to the fact that how much money has been borrowed over the last couple of years, especially during COVID. Imagine how many businesses borrowed money or got bounce back loans and all of those other things that they did. The reality is can the Bank of England afford to put the interest rates up so much where people will have huge amounts of debt, which were spiraling? Again, I just don't think they can. So what do I think overall? I think that the property market will still be increasing this year. I don't see it doing what it did last year. But again, the first 3 months of the year have simply bucked that trend, and we are seeing the same kind of figures that we saw at the end of last year. The biggest thing for me is the supply. I personally think that the supply and the restriction of supply, that is what is going to keep the market going and keep the market on fire. Now, go back to the question that I said at the beginning of this webinar, and when I said to you, keep in your mind, what would renters do? You've got a renter in your property. And let's not talk about family rents, because that's a slightly different thing. If you've got things in there, if you've got people in there, family rents, and their cost of living, and they're struggling, they've got a couple of kids, they're struggling, their electric bills have gone up and they're struggling. What happens there? Well, the reality is you might have a number of unpaid rents or unpaid months. Now, that's the downside of the sort of houses on the outskirts or the family rents, is those families are going to be squeezed. What we're looking at, and where I've always done my buy-to-lets and where I always recommend people do their buy-to-lets, is the disposable income category. The younger professionals, they earn good money, but they don't have dependents that they have to provide for. They don't have as many bills and outgoing costs. So to rein in their outgoing costs, they can simply not go out, but they can still afford their rent. They have a lot more disposable income when you're younger than you do, ironically, when you're sort of like in your mid-30s. So the majority of our demographic, they range between 24 to 29 is our demographic for our renters. They pay on time. We very rarely have a missed rent or no rent at all. So we've only ever had that one or on 2 occasions in the whole decade of doing this and all the properties that we let out. But the reality is that that's the demographic we're aiming at. And if property prices keep increasing and the cost of living keeps increasing and their disposable income is getting marginal, or it's not as much as it was, they're going to keep renting. That's the brutal reality. And if you look back in history and you say, well, how many renters do you have in an upturn and how many renters do you have in a recession? More people rent in the city centres in a recession than they do in an upturn. So while property prices are still increasing and the demand for rent, and there's an article in the Telegraph only this week where rents are increasing throughout the country, rental demand is increasing throughout the country. Again, this goes back to the supply of properties as well, or the lack of supply. And of course, the prices are increasing. You've got great rental income, great property growth. Again, that just simply equals a great investment. And I just genuinely don't think we're going to see that crash that people are concerned about, worried about. People are looking to sell their properties because they think there's going to be a crash. I don't think there will be. One thing I would say, and there's a caveat to all this, is if we start to see interest rates 4 or 5%, totally different story, guys, but I just don't see that we're going to be there. So look, let's move on in terms of some questions and an answer session. And we can then cover things like what's directly happening in the property market. We can cover Brexit and how that's still having a bit of an adverse effect on the cost of materials coming in. So it's now over to you guys, really. Let's talk about any questions and answers that you've got, and then we can go from there. So if I sort of stop sharing my screen, there should be a bit of a bigger version here. So let's have a look at some questions here. So it's a good question here. How does a rise in the cost of living impact short-term lets? Well, That's a really good question. Again, typically what you'll find is you've got to look at why do people do short-term lets. So the people that do short-term lets have obviously got more disposable income. They're heading somewhere for a weekend, whether it be coastal area or city centres. You've got people heading to, for example, we do some in coastal areas, but we tend to find city centres are actually better short-term lets because they're not seasonal. Whereas if you head to the coast, you've got, your main summer months are the seasonal months, and then it's quiet for the rest of the year. But in the city centres, we especially excel in places like Manchester, where you've got two major football clubs play week in, week out, Champions League games, FA Cup, League Cup, Premier League. You've got arenas there where you've got concerts, events, boxing, the whole lot. So we tend to find that the most important thing is if you get in the right area. We actually don't find that the downturn affects it in a dramatic way, because what people do is they start to simply go closer to home. So whereas typically you might have someone takes a holiday overseas, what you'll tend to find is people say, well, actually, if the cost of living is getting a bit punchy, we won't go on that overseas holiday. We'll have a few weekends at home. And you tend to find that short-term lets actually increase during that kind of term, because people holiday more at home. They know it. They don't have all the cost of going overseas, currency changes, etc. So actually, short-term lets should increase. Next one here, we've got once an off-plan house is booked in exchange, can the builder change the price due to the more cost of construction? Again, another really good question. So no, they can't. Legally, they can't. What they can do, and what we've seen over the years, is a developer has said, for example, let's say that you've got 10 off-plan houses that cost, let's say, £500,000 each to build, and they're going to sell them for £1 million. So they cost £5 million to build overall, but they're going to make 10 million, so they're going to make 5 million profit. If the cost of that property then goes up to £1 million, so there's no profit on it, the developer has a choice. They either simply carry on and build, or they could theoretically come to you and say, look, the cost has gone up, we're going to down tools. We've only received 10% of your deposit, we're going to down tools, and we're not going to build, and we're going to go into administration. Now, what most people would then do is they would most say, well, how much more do you need? And they'll pay it. The reality is they can't legally do that. They can't legally ask you or tell you you've got to pay more money, but they can ask for it. And we've seen it done before. We've actually seen it recently in one particular development. And it depends on the size of the development. My advice would be that if you're one of 200, well, let everyone else pay for it if they're going to pay for it, and you don't pay for it. That would probably be my advice. That's what I would personally do. They're not going to not build because one person hasn't paid it. They cannot force you to pay it, but they can use a bit of leverage and say, well, the reality is we're not going to build, and we're not going to build until you pay us X amount, or we go into administration. They can theoretically do that. What you've got to do is you've got to weigh up, actually, is that likely to happen? But yeah, if you want to sort of email me in greater detail on that, I'm more than happy to look into it for you. No problem at all. Let's have a look. The previous recession did not cause the type of squeeze that is being suffered currently on wages. Will these professionals still be in a position to rent, even on short term lets? Yeah, they will. So you're right, the previous recession didn't cause the type of squeeze on wages, but what it did cause was the lack of liquidity with the banks. And the lack of liquidity with the banks means people, they have more restrictions on things like overdraft, more restrictions on could they get mortgages, could they get loans, could they get lending. So yeah, I agree. I think that there is going to be a bit of a bigger squeeze on wages. But what we had before is during the previous recession, property prices fell and people could actually afford to go and buy it. If property prices fell 15%, which they did in 2008, 2009, and wages didn't, even though people might have had a bit more of a tougher time getting a mortgage, there were still mortgages out there. And the reality is they had a then 15% discount on their house that they could go and buy. They don't have that luxury now. So even though that they've got a bit of a squeeze on their wages, well, the reality is most people, the younger demographic, are going out to eat, they're going out to drink, they're going out on weekends. What then they're going to probably find is that if people have had a squeeze on wages, they're going to have to stay in a little bit more. But in terms of short-term lets, I think you're going to be surprised. The reality is there's still a lot of money out there. And I think everyone that's on this call and on this webinar, have a look at your own pockets. If anyone is really struggling and their wages are so tight, they're probably not going to be on this call. That's the reality. They're probably not looking for a buy-to-let property. And for those people who are pretty tight anyway. And you know, we see these people where the cost of living has impacted, and we see, you know, I go in local supermarkets now, and there's boxes on the side where people can go and take food because there's sort of these food banks. But the reality is that that's not your target market. Your target market isn't going to be those kind of people anyway. Your target market is going to still have that affordability. So the cost of living squeeze isn't going to impact our target market to the extent where they can't go on short-term lets or they can't pay their rent. So let's have a look, guys. We've got a couple of raised hands over the other side. Let's have a look. For short-term lets, do you recommend any particular cities? Again, as I said before, you've got two choices. You've got city centres or you've got coastal cities. I personally always go for city centres because coastal cities for me are seasonal. And I've had properties, and we've managed properties before. Coastal cities, they're fantastic during the summer months. 6 weeks, they're high volume, booked a year in advance and great money. But then you come sort of like, you know, on a cold, dark night in November, and you've got nothing at all in there for months. And what then happens is you have issues with pipes and burst pipes and things. So I always say get city centre short-term lets, and places either Sheffield, Liverpool, Leeds, Manchester, all those kind of places where the property price is still good enough to buy, low enough to make a great short-term let buy. Another question here: is the short-term let rent set to increase from the previous projections, and are Skylet management fees also increasing as a result? No, so our fees have remained the same, 12% plus VAT. There are other good companies out there, but I know what they charge. They charge 18 to 24% plus VAT. We're efficient at what we do. We're going to run it with, as I say, our 12% plus VAT, so it's just over 14%. We know we can run it like that. And the reason why we can is what we don't do is we don't take, you know, one in one building, one in another, and then therefore we've got a higher cost for sort of cleaners running around. We'll take X amount in one building, a large chunk in one building, so a cleaner can get in, and it's basically economies of scale. They're cheaper because they're in the building and they can go, for example, through numbers, doors 1 to 20, and get it all clean, for example, rather than having to go from one place to another. So because we're more efficient like that, and we'll only take on what we actually advise on, we can run it on a cheaper cost. So is it a good idea to have a short-term let and single buy-to-let in the same limited company or separate ones? Again, good question. So what I would say is, with the cost of corporation tax increasing, now I can't remember exactly what it is, guys, so I'm going to sort of hazard a guess. It's something along the lines of if you earn over, I think, £50,000 profit, your corporation tax goes up to 25%, I think, something like that. If it's under 50,000 profit, it's 19%. Well, the reality is that you don't want to go over 50,000 profit. So therefore, you're probably best setting up in multiple companies. Again, it's one to speak to your accountant about. But the reality is that you just keep it under that £50,000 profit. You don't want to put too many in the same company. Also, think about future proofing. Are you going to be selling the company on? So when you sell the property, are you going to be selling it on to another investor? Maybe you want to sell one property and not the other. So if you're in the same company, you have to split them out of the company. If it's in the company, someone can come along and just buy the company. So typically what I've found is investors, they buy one property per company, and that's probably the best way forward. What's the minimum tenure for a short-term let? Again, you can do a short-term let for a day. Whether that's viable or not, probably not. With all the cleaning that has to be done now due to COVID, and they have to use different material, different sort of cleaning equipment, etc. I probably would say you'd want to do at least a 2-day let or 3-day let, have sort of like good weekends let, and in the week a 2-day let. That's personally what I would do, minimum of 2 nights. If that's what you mean. If you're talking about the holiday let tax breaks that you can get, that's a different story. That's where you sort of have to have it let for over 105 days of the year, available for over 210 days, and not for more than 30 days. But if you mean what's the minimum tenure, I'd say probably minimum 2 days. What do I think about student accommodation near universities? Again, student accommodation is good. The only downside of some student accommodations is that they put them in the middle of nowhere, and they say they're great student accommodation. They're 20 minutes from the university. that's no good. Students want to be as closer than a 20-minute drive away. 20-minute walk, no problem, but 20-minute drive, no chance. And also what you have to look at is how much student accommodation is in the area. But no, student accommodation can be really lucrative, great for income, not as lucrative as growth as a residential property, but they can be fantastic for income because they're rented for either 48 or 51 weeks of the year. But again, like any buy-to-let, it depends on the area, depends what you've got, depends on the management company. There's a lot to be said for a good management company in a student property. But again, if you send anything over, I'm more than happy to run my eye over it and get back to you on it, no problem. Is short-term mortgage, short-term let mortgage, sorry, different to a single buy-to-let? Yeah. So when you're going for your mortgage, you can tell your broker that you're going to do a short-term let on it, and there might be other lenders that he would advise that you go with. Again, the same thing is, if you've got a buy-to-let, you can't go and get a residential mortgage on that buy-to-let property. I'm sure many people do, but the reality is that you can't. It's mortgage fraud. So what you want to do is you want to tell your broker right from the start what your intentions are with the property, how you're going to let it. Although there are some people who don't have any intention of short-term lets. I'm sure the majority that you see on Airbnb don't have a short-term let mortgage. They probably have a normal, probably a lot of them have residential or buy-to-let mortgages, and they've just evolved into a short-term let. But my advice would be, look, if you've got a good lender and you're paying month in, month out, and it's a buy-to-let mortgage, and then you suddenly turn around and say, look, I'm going to do short-term lets, and most won't have a problem with it, I'm guessing. But yeah, I would definitely tell your broker. What's the average occupancy rate for short-term lets in core northern cities like Liverpool and Manchester? I'd be aiming, so pre-COVID, I would definitely be aiming at over 65%. As soon as COVID hit, it was well down. It was, under 20, sometimes even lower than that, under 10%. But we've now bounced back, and I would be pushing for sort of your 55 to 65%. Again, it depends on where you're buying. If you've got a really expensive property, even if it's in the heart of the city, you're not going to get rentals on it. It just might be too punchy in terms of the cost per night. So it's all about location in combination with the price. That's the key to me. You've got to have a good location and the ability to have a good price. Because if you've got a property which is lovely, but you're charging £400 or £500 a night, they're going to go and get a hotel for £250 a night. Whereas if you've got a good property in a good location, buy a tram stop, for example, you're charging maybe £120, £150 a night, and you've got a hotel close by who's also charging £150 a night. But with the hotel, you don't have obviously the facilities of the cooking, your own kitchen, your living room, etc. Then they're going to go with a short-term let. So there's a lot dependent on that, but I would be aiming sort of like well over 55, 60%. Is it best to invest as a private person or a limited company? I can't answer that. It just depends on you. It depends on you, your circumstances. Could be, I don't know if you're based in the UK, overseas. Do you a higher tax rate payer, lower tax? There's so many variables, but that's definitely something to speak to your accountant about. They'll be far more au-fait with your particular personal circumstances than I will, and far more qualified as well to answer you on that one. Are the developers you work with set to complete their projects on time in Birmingham, Manchester, Bradford, or is the current economic climate causing delay? Good question. So we've got a couple of projects, one in Liverpool in particular, who's had a big delay, well over 18 to 24-month delay on it, partly caused because, in my opinion, disorganisation, and partly because COVID and construction industry and the lack of or the increased amount of costs. So yes, there have been delays. Most of the stuff that we're launching now, especially within the last 3 to 4 months, has been absolutely spot on, and we've had no problems with it whatsoever. Wind back 6 to 9 months, those launches, they might be a few months delayed. A lot of off-plan stuff gets delayed. Any company that's out there that says they don't have delays is lying to you. There's always something. There's always a slight delay. But everything we're launching now has been pretty much spot on. Especially, we've got a couple of developments we've done in Manchester, which is 5-6 months away from being completed, and they're absolutely on point. So yeah, no problems at all. How much difference does a parking with serviced accommodation make? Is it more desirable as the property is not in the city centre but about a mile away? Is it more desirable as the property is not in the city centre but about a mile away? Depends on the transportation. Think about yourself. Why would you go to a city centre, and where would you want to go? Would you drive? Would you get the train? Would you get the tram? If it's within the city centre or within a tram or a train stop, no, probably no problem at all. But if you're going to need to drive there, then yes, I would recommend I'd recommend a parking space, or at least have the ability to be able to get maybe a permit or something like that nearby. But again, more than happy to have a look in detail in that particular property. Got here, St Anne's is under construction now. Do you know the probability of developers asking for additional money to complete the building? Yeah, good question. No, I don't know if they will or not. I don't think they will. I think they would have already done that by now. They've recently got on site within the last week or two. So I think if they were going to ask for more money, they would have probably done it before they got on site, if I'm honest. Never say never. Yeah, I'm just glad it's underway. It's been heavily delayed. This is the Liverpool project we're talking about. But yeah, I hopefully foresee this pushing on nicely now. They've not mentioned anything to me about, oh, we might have to go back and ask for more money, and they're now on site. I think if they were going to do it, it would have been done by now. Copy the chat. Oh, okay, same question there. Sorry, I didn't see the other chat there, guys. Is St Anne's all sold off? No, there are a number of units in that are being sold by other agents. We held off from selling it until we saw them on site, and anyone that was in the midst of exchanging, we held off until we saw them get on site, and we had a plan, and we had a build schedule, which we now got. So no, there are still units in St Anne's, and they're being sold by other agents, and they were actively being sold previously. We just decided to hold off because we felt more comfortable once the developer got on site. Right, guys, well, that looks like all questions asked and answered. Hopefully it's been a really useful webinar for you. Oh, sorry, guys, there is one more question just come through. Is St Anne's a good place for service accommodation? Yeah, again, with St Anne's, I think you're 10 minutes from Liverpool main train station. Everything's a short walk. Taxis are really cheap as well. I mean, you're probably talking about £3 in a taxi from Liverpool Lime Street to St Anne's, if that. So yeah, I do see it being a decent short-term let. So look, guys, I think that is all the questions now. So guys, hope it's been useful. And if you're watching this back on YouTube, as I say, don't forget to subscribe and like this video, and you can get some real-time information updates on buy-to-lets. And look, hope you have a lovely rest of the month, a good week, and a good bank holiday for those of you that are in UK and have a bank holiday. And take care, and I look forward to speaking to you soon. Bye-bye.